I want to start on your thesis about where we stand in Europe. You say European equities have outperformed global markets this year, overcoming vaccine hiccups and reimposing regional lockdowns. Why is Europe, you say then, outperforming with these negative pandemic trends? Because there are larger forces at play. These are your words. Wouter, walk us through these larger forces.
Hi, Anne-Marie, and thanks for having me. And you're absolutely right. We do think you need to look beyond the disruption in terms of the vaccine rollout and look at the real exposures that you're buying into when you're buying into European equities. From a revenue standpoint, European equities get more than 50% from global sources, which means that the global recovery led by the US and its fiscal stimulus is still going to have a positive impact on European equities. On top of that, we know that Europe, in terms of its sector exposures, is more exposed to the value and cyclical side of things, which in a recovery is a positive thing. So that's helpful as well. Not only that, because European interest rates are more contained, we've seen a bigger rise in the US. We also see that interest rate sensitivity, which is of course very much also a tech sensitivity, is less of a factor in Europe as well. And then finally, Europe also has a benefit from a little bit of a geopolitical boost from Draghi taking over the prime ministership in Italy, as well as sort of the more, let's say, the more moderate side of the political spectrum in Germany taking hold of the leadership transition after Merkel steps down. So those are the four factors that are driving our preference for Europe at the moment.
The one question I have, and to push back on this, is the fact that we are seeing renewed COVID cases. Look at France. We're having to extend their lockdown to 4 other regions, and Germany is potentially going to today announce stricter border controls between the two countries. At some point, does this threaten the outperformance of the European equities?
Well, we are actually quite optimistic that that will be pretty contained. You're absolutely right. We're not blind to the fact that the vaccine rollout has been disappointing, that the recovery has been delayed. However, we still think it's delayed but not disrupted. So it should be a month or two in the future when we still get going. And we think that period is too short for the markets to really get worried about the underlying outlook for the European recovery. So we know every month of delay is about 4/10 in GDP. Now that's significant, but it's not the end of the world given the enormous amounts of swing we have seen in GDP. So it's that sort of relativity that we're looking for. And we should also recognize that 2 to 3 months from now, everybody is expecting a vaccine glut as opposed to a vaccine shortage that we're currently dealing with. So it's just getting over that hump for the next 2 to 3 months, and then hopefully the recovery will get going in Europe as well.
So you say delayed but not disrupted. For Europe specifically, what's the timeline?
Yeah, so of course that's still a little bit uncertain because of the issues we've seen with the exports, with AstraZeneca, with the J&J vaccine coming online. So we have to be a little bit careful trying to be too specific here. But I do think that, looking 1 quarter out, so 3 months out, we are pretty confident that the vaccine glut story that we've been focused on will be here. And that would mean that from that point on, we should see a pretty robust recovery. So that's really the second half of the year. We're very confident that the European recovery will get going, just like the US recovery is already starting as of the second quarter of this year.